If you're looking to purchase a commercial property, there are two main options: buying the commercial asset directly yourself or pulling your money together with other investors. For the majority of investors, buying and managing a commercial property individually is not a financially viable option. Even if it is, putting a significant portion of their funds in one investment can pose a greater risk, particularly if you don't have the experience and expertise to identify, secure, and manage a good commercial investment. For this reason, many investors choose to allocate their capital to a commercial property fund. So if you want to know what these differences are, then this video is for you. Exclusive for Real Estate Real Talk members, we will discuss how a commercial property fund works. So without further ado, let's get into the video. What is a commercial property fund? A commercial property fund is a form of property investment where investors buy a share of a commercial asset held in a professionally managed unit trust. Rather than investing in a commercial property individually, a number of investors pool their capital together to purchase a property or a group of properties, which are then managed by a professional asset management team. The individual contribution that each investor makes will represent their share of the asset. For example, if a group of investors purchase a neighborhood shopping center worth $15 million and gear the asset to 50%, they would require $7.5 million in upfront equity. Rather than one individual raising all this equity for the asset, you might get a number of investors contributing $50,000 or more for a share in the property. If an investor were to contribute $750,000 towards the $7.5 million deposit, they would then own 10% of the asset, meaning they would receive 10% of the income distribution from the property as well as 10% of any capital appreciation upon sale. Commercial property funds can be broadly split into two categories: those that offer fixed income or those that offer equity-based returns. Fixed income funds provide investors with an income stream over the term of the fund, while equity funds allow you to take advantage of rising market values by selling off your share at the best possible time. Many property investors prefer the familiarity of investing directly in residential property, but commercial property can offer a simpler and lower-cost alternative. Commercial property is a great option for those who have their own business and need to expand their reach. The success of your business depends on having an efficient office space, which is why it's always important to keep up with the latest trends in the area. Commercial real estate can often be obtained at a lower price than residential properties because it doesn't have the same competition. This means that you can buy commercial property at a significantly lower price than if you were buying an individual home. If you want to get started with investing in commercial properties, there are many different types of investment vehicles available to you. You can choose from debt investments such as bonds or loans, or equity investments such as stocks or shares. Each type has advantages and disadvantages depending on your goals and needs as an investor. When you think of commercial properties, what comes to mind? Maybe it's a high-end shopping center in the heart of London, or maybe it's an old movie theater that has been converted into an office building. Whatever you think, these investments are some of the most sought after by investors. But why? Because commercial properties cost millions of pounds to purchase or build and can command huge rental incomes. But in most cases, they're impossible for smaller investors to buy outright. That's where investment funds come in. They allow many people who otherwise couldn't afford these types of investments to get involved with them. For example, if you want to buy an office building but don't have the money on your own, you can invest in a unit trust or an open-ended investment company. These products are organized as trusts that have managers responsible for managing the fund's operations. They offer investors a way to invest in commercial property without having to go through all the hassle of purchasing it themselves. These funds either directly own properties and pay your returns based on their growth in value and rental income, or buy shares in property-related companies, paying your returns based on the growth in the value of the shares and the payment of dividends. You usually only need around £500 to invest a lump sum in a property fund, or £50 per month for regular savings. There are three categories of commercial property: Retail property, including shopping centers, supermarkets, retail warehouses, and high street shops. Office property, purpose-built for businesses, these often require installation of high-speed internet and other services essential to businesses. Industrial property, such as industrial estates and warehouses. So what are the benefits of commercial property funds? Commercial property funds are a great way to get into the commercial property market, but only if you have the means and desire to purchase a high-quality asset. For most people, investing in commercial property directly isn't financially feasible. This is especially true when it comes to purchasing a high-quality asset that meets your needs. Commercial property funds allow you to enter the commercial property market without having to make large deposits or other sacrifices. By investing in a commercial property fund with others, investors also have the opportunity and means to access a higher quality property that they otherwise may not be able to afford on their own. Investing in commercial property funds can be an excellent option for anyone looking for more flexibility than purchasing a direct investment into real estate would afford. Investing in real estate can be a time-consuming and often difficult venture for time-poor investors, and one that requires sophisticated knowledge of the market as well as regular management. Contrary to joint ventures or direct ownership, whereby investors are responsible for the management of the commercial assets in their control, commercial property funds will typically assign a professional asset manager who will take care of these items on the investor's behalf. These asset managers aren't just responsible for the daily management of the property itself, but can also be invaluable in guiding the strategy surrounding the acquisition and long-term potential of the asset. It can be difficult to maintain the rent of your buildings in the face of changing market conditions. With the right strategy, however, you can ensure that your tenants are always able to pay the rent and that the property is always in good shape. These can include key strategic elements, such as ensuring the properties have a strong, diversified tenancy mix that holds appeal for a diverse range of industry tenants, as well as monitoring industry trends and identifying value-add opportunities to increase the asset's long-term growth potential. This knowledge in industry trends is particularly important in today's evolving market. With modern technologies such as automation and online retail driving, changes across the retail and industrial sectors. While this might sound like it would be an issue, many investors find that having someone else handle these aspects of their investment means they can focus on other parts of their portfolio with more ease. As such, we think this is an excellent way to save yourself some time by letting someone else do what needs doing so that you can get on with other things. Commercial property funds are a great way to invest in commercial real estate with the potential to generate excellent returns. But they have a few key advantages over other forms of investment, and it's important to understand how they work before you invest. First, commercial property funds are often much less risky than other types of investment. This is because they tend to focus on properties that are high in demand or close their target market, which means there's less risk of losing money when something goes wrong. Commercial property funds also tend to invest in properties that have been underperforming for a while, so you won't be betting on the success of an entire building or neighborhood. Second, commercial property funds offer more stability than other forms of investing because they are backed by an insurance company that will insure all losses if something bad happens, while you're holding on to your shares in the fund no matter what happens in the underlying asset. This means that if something bad happens, like fire or flooding at one of your investments, then your insurance company will cover all the losses, no matter what else happens with that particular investment. Finally, because commercial property funds tend to focus on specific areas rather than individual buildings, they're much easier. As full-time professionals in the commercial industry, they will often have access to additional resources and market contacts that simply aren't accessible to the typical investor, such as off-market deals, potentially opening up a wider range of investment opportunities for investors. A strong acquisitions team will also provide the expertise required to negotiate a good deal on the property, or as the case may be, to spot a deal that is too good to be true, or holds hidden flaws that could impact the property's value or income-producing potential further down the line. This can be a key factor in mitigating the risk involved for investors in the trust. Commercial property investment carries risks. Commercial investors always face the possibility of unforeseen circumstances, such as tenants leaving or going out of business. But this risk can be even greater for investors who opt to purchase a single asset directly. In addition to the risk that an asset may not perform as expected, there are also the costs associated with maintaining a commercial building, repairs, maintenance, utilities, and taxes. Because these costs are often greater than what you would pay for rent in an office building or retail space, purchasing a single asset can be less attractive than investing in an entire portfolio of properties. Diversification into the different asset classes and industries is a strong investment strategy for those looking to protect their capital and boost the growth potential of their investment, but can be hard to achieve for investors opting to purchase a high-cost asset directly. This is often seen as one of the biggest benefits of investing in a commercial fund, because investing in a fund typically requires a smaller amount of capital. This often allows investors to spread their capital across multiple assets and industries, hence mitigating the risk of hedging all their bets on one asset class. For example, let's say you have $100,000 to invest in stocks and bonds. You could buy one stock outright, or you could purchase $10,000 worth of shares from a mutual fund that invests in several stocks but also has bonds as well, like Vanguard Total Stock Market Index Fund or Vanguard Total Bond Market Index Fund. In this scenario, your portfolio would be diversified across 4 different asset classes: equity, fixed income, real estate, and commodities. Commercial property funds themselves can also comprise multiple assets, providing additional diversification across different industries and boosting growth potential should one particular industry experience an upturn. There you have our real estate real talk video for today. Don't forget to subscribe to our channel, click the notification bell, and like this video. If you think we've delivered value, please share this video with one person. Just one share is enough for us, for you to show your appreciation for the commitment and hard work we all put together in creating this video that teaches and helps you on your mission of building your own fortune. And you don't know that one share could go a long way. Keep in mind that no matter how many times you're going to watch this video, you won't see any results unless you take action. Goodbye and see you in the next one.